Welcome, everyone, to a special edition of the Daily Macro Update for Friday, August 22nd. We're about to go live for the Fed's Jackson Hole Symposium speech by Jerome Powell. This is his last Jackson Hole speech for his time in office, and so we're going to be getting into that here in about 15 minutes. It starts at 10 a.m. But in the meantime, we're going to go ahead and take a look at some of the macro data as well as some of the setup here heading into the meeting. And so first, I want to highlight the change and shift in the target rate probabilities for the September meeting, right? So when taking a look at the Fed Fund futures for the FedWatch tool here, you can see how there's been a pretty interesting shift from a nearly 100% pricing in that the Fed was going to cut by 25 basis points just last week to now being about a 70-30%, meaning 70% that they're going to cut by 25 basis points and nearly 30% that they're going to remain paused. This is a large shift from last week. But, you know, there's still a large majority probability that they're still going to cut by 25 basis points, which I still think is the case. You know, we'll see what happens from here. It really just depends on the inflation data. And so, you know, over the past few weeks, as you guys who have been, you know, paying attention to the channel have seen, the whole thing is that we want to make sure that we're paying attention to the inflation data that's coming in. Last week we had CPI. You know, that reading suggested that inflation wasn't directly coming from tariffs, right? Consumer prices. But then we received the PPI data, which showed that, you know, the effects of tariffs were very clear in terms of producer prices. And that, you know, we just haven't seen that carry through over to consumer prices just yet. But we could see that here coming into the next CPI report. And so when we take a look just on August 11th, this was a snapshot from the August 11th Cleveland Fed's inflation nowcast. And as you can see, core PCE, which is the Fed's preferred inflation gauge, they had that around 2.9% for both July and August, as well as for the headline CPI at 2.9%. If we take a look at the updated numbers today, you have the CPI actually down to 2.8%, but you've had core PCE rise to 2.9 as well as 2.96, which would read at 3.0, which is definitely a large acceleration. And so really we're going to get a clear answer on if the Fed is ditching its 2% target, which I think that's what it's been signaling. But two, you know, you could get, even if they do cut by 25 basis points, Fed funds are still going to remain at 4%, which is still a lot higher than the average rate for the past 15 years between 2008 and 2020. And so how much really would that help, you know, the actual rates coming down, right? So in any case, even after the September meeting, you're still going to have the average Fed funds rates relatively elevated. And so, you know, taking a look at that, as well as when we look at the Fed meeting minutes that was produced on Wednesday of this week, we saw that, yes, you know, they remained, you know, paused with their target rate of 4.25% to 4.5%. But you also had dissenting members, right? So Governors Bauman and Waller wanted a quarter-point cut at that meeting. And they were essentially citing the softer growth and rising downside risk to the jobs market and effects to tariffs, right? And they were saying that they're very transitory on the effects of tariffs on inflation. And, you know, the Fed's record on that word transitory is definitely not a great record, but it was interesting seeing the dissenting views from those two governors. You really haven't seen that since early 2000s. They did highlight how growth moderated in the first half of 2025, as well as the labor market did remain solid with the unemployment rate still at low percentage points, right? So the unemployment rate is still at 4.2%, as well as you have inflation remaining above their 2% target. So if they were just going off of their dual mandate, they wouldn't be suggesting any type of cutting of interest rates, but you're having that pressure from the fiscal side of things because of the debt problem, right? They also cited that they were going to continue their quantitative tightening, right? So their balance sheet runoff, they're still going to remain that, and that still puts some downward pressure. But at the same time, they are continuing to drain the reverse repo facility in order to rebuild the Treasury general account, since the market is, or since the Treasury is issuing a ton of bills at the short end of the curve, right? And so reserves are likely to trend lower, and we should see a little bit of a tightening on that front in terms of central bank liquidity, which could be some downward pressure in the near term. But at the same time, I mean, the government is blowing out their deficits, so that is more of a stimulus. So you're getting crazy stimulus from the government and a little bit more of the balance sheet runoff from the Fed. But this is really more so in the environment that we're in right now is fiscally dominated. And so, if you have a Jerome Powell coming on TV here saying like, hey, we're still going to think about cutting rates, that means that, if they come in dovish, that means that, they're essentially giving into the government's demands. And yeah, we are definitely in a fiscally dominated environment at that point, which if you look at history, whenever governments kind of take over for the quote unquote independent central bank, that's where you get into a lot of trouble. Now, what's interesting is that, heading into the meeting here, you have levered funds. So these are large institutions that, like hedge funds, things like that, financial institutions. They have been really piling in on the short side, hedging into the event today. And so, you could potentially have a squeeze go on, right, in a short-term reaction. Heading into the charts here, you have the dollar having a decent rise, as well as you've had bond yields also tend to rise into this. And so if you do get bond yields coming off, if the Fed is a little bit more dovish, then you could see a little bit of a squeeze and an unwind of those hedges that we're seeing head into this, right? You still have the VIX well in bearish trend here. So, I mean, that is somewhat of a bullish, well, that is a bullish development for the S&P 500. Who knows, again, what the initial reaction is going to be today. Right now, you are seeing a little bit of a decline in the VIX. And so as a reaction to that, you are having the S&P 500 having a little bit of a lift here. And, taking a look at our ranges for today, I mean, this is coming right off of the bottom of the trading range from yesterday. And so, yeah, I mean, you are getting a positive reaction already. And again, this could be because so many people are bearish that these past few trading days of downward price action on lower volume has been just, the market pricing in a lot of hawkishness. And so if the Fed comes in a little bit less hawkish, neutral, or even dovish, you could have an unwind of a lot of that bearish trend. So, it's definitely an interesting setup heading into this. And so, you did have NVIDIA having a little bit of a buying opportunity here this morning. That's, up a little bit. Lots of the mega caps having a decent day. The biggest one up so far have been Google as well as Tesla. So those are having kind of some of the bigger moves today. But yeah, so I mean, you're having a bit of a positive reaction just because of the negativeness. And, I wouldn't be surprised if we did have some type of squeeze from just the pile of shorts that have been going into this event and the extended bearishness. And, if you do have bond yields start to come off, it'd be interesting seeing, what the reaction is from gold. Gold has continued to remain, going sideways pretty much since, late April. kind of similar to what the yield curve has been looking like. If you look at what the yield curve has been doing, it's been relatively flat. Some crazy whipsaws over the past month, and as of recently, since July 15th, you've had the 10-year bond yield decline faster than the 2-year, which typically suggests more of the bond market pricing in a weakening economy. So that is definitely interesting there. Let's see here. The best performer yesterday, interestingly, was small caps. If you take a look at the Russell 2000, take a look at small caps. This has been a very bullish trend, pretty much since the bottom of it from April. It's not yet near where it was near all-time highs back at the end of November of 2024, but it is interesting seeing how small caps have been beating some of the large caps this week. And then also, too, speaking of small caps beating large caps, you have Bitcoin continuing, having a little bit of a more of a weaker positioning this week, while Ethereum has continued higher. So not only are we seeing small caps beat large caps in equity markets, but you're also seeing small caps beat large caps in the crypto markets too. So a lot of that is very interesting developments there. It's really just showcasing the risk-on environment that's still apparent here. And yeah, you still have credit spreads bearish. And, when you have bearish credit spreads that are narrowing, you do have more of a risk-on type of environment. And so, if we do see this push higher, then, we could see more of an unwind of of some of the bullishness that we're seeing right now. But even if we do have a correction here coming up, what I'm going to be looking for are assets that are remaining in bullish trend despite the sell-off here. So let's go ahead and tune into the speech here. And yeah, it looks like it's going to be coming on in about 3 minutes. So what I'm going to do is, let me just remove this here, and then 1 second. All right, there we go. So this is coming on in about 2 minutes here. So we'll go ahead and take a look at some of the questions that you guys have. What do you say about the impact of this bearishness over Bitcoin and Ethereum? Do we see a short squeeze or a long squeeze? I don't know specifically. We do have a large options expiration next Friday for Bitcoin, but really the flows have been pretty obvious, right? You're seeing flows go from Bitcoin to Ethereum, right? Flows from large caps into small caps. That's, similar to how 2021 looked, right? So far, this second half of 2025 has been very similar to early 2021, which was one of the most bullish markets that we've seen. So yeah, I'm having a little bit. My team and I are having a little bit of a contrarian view here, but yeah, I mean, just to reiterate the setup here, you have the dollar and bond yields near the tops end of their trading ranges. You have large caps that have been selling off all week. We'll see if that unwinds here as Jerome Powell takes the stage. And yeah, we'll see what happens. So good questions, good questions. So you're saying if they cut rates in bearish long-term, maybe bullish short-term? Yeah, essentially, if they are going to be more dovish, it depends on the context, right? If he's saying that they believe that inflation is going to continue coming down and growth is going to recover, then sure. So wasn't the expiration of the option today? No, the large expiration is next Friday. Yeah, great question though. Good questions, good questions. Yeah, Sam, I was talking about Bitcoin options. Let's see if there's any type of questions from... How can Trump expect lower rates and implement tariffs that everyone knows that it will rise inflation? Yeah, I mean, that's the real concern, right, is inflation. And the Fed has had a not so great track record. So, yeah, I mean, that's what they're concerned about. Do you think crypto will turn bullish? Crypto, there's a lot of cryptocurrencies that are already bullish. So I'm not sure what you mean there. Betting markets all think of a cut announcement. Actually, really, the setup has actually been, a lot of people have been expecting, or the market has transitioned into more of a hawkish thought process. Are you live streaming the Fed speech? Yeah, if you go to our YouTube, it's right there. Johnny, you always talk about the trading ranges. How do you calculate them? Well, I mean, the calculation is proprietary, but what we take into account is price action, structure. We also take into consideration the macro environment. We also take into consideration the performance of volume and volatility as it relates to the price action. But all those things get taken into consideration with our ranges. If the address seems dovish, how high do you think gold can go? I'm not sure. We'll see what happens here. Let me try refreshing this.
Labor market remains near maximum employment, and inflation, though still somewhat elevated, has come down a great deal from its post-pandemic highs. At the same time, the balance of risks appears to be shifting.
Let me know if you guys can hear it.
In my remarks today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework, as captured in the revised Statement on Longer Run Goals and Monetary Policy Strategy that we released today. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Market committee meetings rated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024.
Dollar down,
rates down. This slowdown is much larger than assessed just a month ago,
S&P
as
up.
the earlier figures for May and June
Bitcoin
were revised
up.
down substantially. But
just like
it
we
does not
said.
appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall-off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%.
This is all dovish tones, by the way.
Roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output.
So far, it's a pretty
Turning
dovish
to inflation,
meeting.
higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data indicate that total PCE prices rose 2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months.
Let's see if he's blaming it on
a notable
tariffs
shift from the modest
inflation.
decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with a 2% inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage price dynamics. Given that the labor market is not particularly tight and faces increasing downside risks, that outcome does not seem likely. Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks
Dollars dropping
may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach.
Dovish meeting, ladies and gentlemen.
Turning then to my second topic. Our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people. We remain fully committed to fulfilling our statutory mandate, and the revisions to our framework will support that mission across a broad range of economic conditions. Our revised statement on longer-run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual mandate goals. It is designed to give the public a clear sense of how we think about monetary policy, and that understanding is important both for transparency and accountability, and for making monetary policy more effective. The changes we made in this review are a natural progression grounded in our ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public review of our framework, which we conduct at 5-year intervals. This year's review included 3 elements: Fed Listens events at reserve banks around the country, a flagship research conference, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In approaching this year's review, a key objective has been to make sure that our framework is suitable across a broad range of economic conditions. At the same time, the framework needs to evolve with changes in the structure of the economy and our understanding of those changes. The Great Depression presented different challenges from those of the Great Inflation and the Great Moderation, which in turn are different from the ones we face today. At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. To me, a statistic that captures that era is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008. Many here will recall the sluggish growth and painfully slow recovery of that era. It appeared highly likely that if the economy experienced even a mild downturn, our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations, triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement included several features that addressed the ELB-related risks that had become increasingly prominent over the preceding 2 decades. We emphasized the importance of anchored inflation, longer-term inflation expectations to support both our price stability and maximum employment goals. Drawing on an extensive literature on strategies to mitigate risks associated with the ELB, we adopted flexible average inflation targeting, a make-up strategy to ensure that inflation expectations would remain well anchored, even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. In the event, rather than low inflation in the ELB, the post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021, we thought that inflation would subside fairly quickly without a sharp tightening in our policy stance, as this slide will show. When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points over 16 months. That action, combined with the unwinding
The
of
fastest
pandemic
rate
supply
hiking
disruptions,
regime ever.
contributed to inflation moving much closer to our target without the painful rise in unemployment that has accompanied previous efforts to counter high inflation. This year's review considered how economic conditions have evolved over the past 5 years. During this period, we saw that the inflation situation can change rapidly in the face of large shocks. In addition, interest rates are now substantially higher than was the case during the era between the global financial crisis and the pandemic. With inflation above target, our policy rate is restrictive, modestly so in my view. We cannot say for certain where rates will settle out over the longer run, but their neutral rate may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. During the review, we discussed how the 2020 statement's focus on the ELB may have complicated communications about our response to high inflation. We concluded that the emphasis on an overly specific set of economic conditions may have led to some confusion, and as a result, we made several important changes to the consensus statement to reflect that insight. First, we removed language indicating that the ELB was a defining feature of the economic landscape. Instead, we noted that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions.
When he says ELB,
the difficulty of operating near
bound,
the ELB remains a potential concern, but it is not our primary focus. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by the ELB. Second, we returned to a framework of flexible inflation targeting and eliminated the makeup strategy. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived a few months after we announced our 2020 changes to the consensus statement, as I acknowledged publicly in 2021. Well-anchored inflation expectations were critical to our success in bringing down inflation without a sharp increase in unemployment. Anchored expectations promote the return of inflation to target when adverse shocks drive inflation higher and limit the risk of deflation when the economy weakens. Further, they allow monetary policy to support maximum employment in economic downturns without compromising price stability. Our revised statement emphasizes our commitment to act forcefully to ensure that longer-term inflation expectations remain well anchored to the benefit of both sides of our dual mandate. It also notes that price stability is essential for a sound and stable economy and supports the well-being of all Americans. This theme came through loud and clear at our Fed Listens event. The past 5 years have been a painful reminder of the hardship that high inflation imposes, especially on those least able to meet the higher costs of necessities. Third, our 2020 statement said that we would mitigate shortfalls rather than deviations from maximum employment. The use of shortfalls reflected the insight that our real-time assessments of the natural rate of unemployment, and hence of maximum employment, are highly uncertain. The later years of the post-global financial crisis recovery featured employment running for an extended period above mainstream estimates of its sustainable level, along with inflation running persistently below our 2% target. In the absence of inflationary pressures, it might not be necessary to tighten policy based solely on uncertain real-time estimates of the natural rate of unemployment. We still have that view, but our use of the term shortfalls was not always interpreted as intended, raising communications challenges. In particular, the use of shortfalls was not intended as a commitment to permanently forswear preemption or to ignore labor market tightness. Accordingly, we removed shortfalls from our statement. Instead, the revised document now states more precisely that the committee recognizes that employment may run at times above real-time assessments of maximum employment without necessarily creating risks to price stability. Of course, preemptive action would likely be warranted if tightness in the labor market or other factors pose risks to price stability. The revised statement also notes that maximum employment is the highest level of employment that can be achieved on a sustained basis in a context of price stability. This focus on promoting a strong labor market underscores the principle that durably achieving maximum employment fosters broad-based economic opportunities and benefits for all Americans. The feedback we received at Fed Listens events reinforced the value of a strong labor market for American households, employers, and communities. Fourth, consistent with the removal of shortfalls, we made changes to clarify our approach in periods where our employment and inflation objectives are not complementary. In those circumstances, we will follow a balanced approach in promoting them. The revised statement now more closely aligns with the original 2012 language. We take into account the extent of departures from our goals and the potentially different time horizons over which each is projected to return to a level consistent with our dual mandate. These principles guide our policy decisions today, as they did in the 2022 to 24 period, when the departure from our 2% inflation target was the overriding concern. In addition to these changes, there is a great deal of continuity with past statements. The document continues to explain how we interpret the mandate Congress has given us and describes the policy framework that we believe will best promote maximum employment and price stability. We continue to believe that monetary policy must be forward-looking and consider the lags in its effects on the economy. For this reason, our policy actions depend on the economic outlook and the balance of risks to that outlook. We continue to believe that setting a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. We also continue to view a longer-run inflation rate of 2% as most consistent with our dual mandate goals. We believe that our commitment to this target is a key factor, helping keep longer-term inflation expectations well anchored. Experience has shown that 2% inflation is low enough to ensure that inflation is not a concern in household and business decision-making, while also providing a central bank with some policy flexibility to provide accommodation during economic downturns. Finally, the revised consensus statement retained our commitment to conduct a public review roughly every 5 years. There's nothing magic about the 5-year pace. That frequency allows policymakers to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. It is also consistent with several global peers. To wrap up, I want to thank President Schmid and all of his great Kansas City staff who work so diligently to host this outstanding event annually, counting a couple of virtual appearances during the pandemic. This is the 8th time I've had the honor to speak from this podium. Each year, this symposium offers the opportunity for Fed leaders to hear ideas from leading economic thinkers and focus on the challenges we face. The Kansas City Fed was very wise to lure Chair Volcker here to this national park more than 40 years ago, and I am so proud to be part of that tradition. Thank you very much.
There you have it, folks. It's a very dovish Powell. Similar to what our thoughts were heading into this, by just looking at currencies, bonds, and the way that positioning was with large institutions.
Thank you very much. We'll move into the presentations. So I want to allow a minute for all of the members of the press to go.
Rid of this here. 1 second. Let's go back to the markets. Just pulling this up. All right, let's go through the market reaction here. All right, taking a look at the charts, we have interesting reaction here. Let me go to, okay, so yeah, the dollar having a bit of, we were noticing beforehand going into this speech how, you had the dollar as well as bond yields towards the top end of their trading ranges. If we go to just the UUP and we pull up the our trading range indicator here, as you can see, heading into just this morning where it was pre-market, that was right at the top end of the range there, right? And so typically when you see a similar set with you had, like we said, the dollar, as well as let's take a look at SHY. You had the 1 to 3 year bond near the low end of the trading range. And so that means bond yields were at the top end of the trading range. So you had that similar set. And you also had equities near the low end of the range. So it's nothing really special, right? It's being able to notice these things and not just focusing solely on one particular market, okay? Part of our strategy here at Macro Optics is being able to look at all these different markets and see what they're pricing in together so that you can, position yourself accordingly. A lot of people just focus on currencies with Forex, or a lot of people just focus on crypto, or a lot of people just focus on, stocks. If you're going to be investing in this market post-pandemic, you have to do all three. Okay, it's not just looking at one particular market. You have to look at these different correlations, similar sets, as well as the setups heading into this in conjunction with your own trading ranges, or if you would like to use ours, you can definitely use ours if you want to be a part of our macro investing community, which you can find in the links below. But yeah, I mean, there's been a ton of different things that have been in bullish trend at the low end of the ranges here over the last couple days that we're selling off. Looks like gold is having a decent reaction to that, as well as silver. Let's see here. Bitcoin as well, off of the low end of the trading range. Nice little pop in Bitcoin. As we were noticing with Ethereum, Ethereum continues its better performance, right? So small caps are having a nice little day here. Yeah, S&P 500. We noted that, for those who are also part of our trading ranges, our daily index ranges, now it's at the top end of the trading range, right? So if you guys aren't already, we have a free newsletter called the Daily Index Ranges, where every single morning before the market opens, I will provide you the daily ranges from our model with the S&P 500 QQQ as well as the IWM. And so, over the past couple of days, we've seen, two opportunities at the low end of the trading range, and now you had a day like this, and now you have an opportunity to sell some. So if you guys are interested in that, it doesn't matter if you're a long-term investor, day trader, options trader, whatever, these trading ranges are able to help you navigate the markets and give you some more confidence on our signal, right? And yeah, so, that's essentially what we saw here. We can go into some questions if you guys have them, and then if not, we can go ahead and wrap it up. All right. So that was the key takeaway, Mr. Moo 9. The dollar dropping essentially means that, it's more of a dovish Fed. Also, too, remember how it was just nearly 70-30 with the target rate probabilities with Fed futures? Look what happened post-meeting. That went from 70-30 back up to a 91.3% chance that they're going to cut in September by 25 basis points. And then this went from 20%, or actually near 30%, all the way down to an 8% chance that they're going to remain paused. It is interesting how that didn't go to zero. I would have actually expected that to go back to zero, and actually some pricing in for a 50 basis point cut. But after that speech, yeah, we've had a dramatic shift towards a 25 basis point cut in September there. Very interesting to see that. What's the probability of having a profit-taking sell-off at these ranges for gold and an S&P? I'm not sure what you mean there, Wiss. How dovish from a scale of 1 to 10? Well, I'll just let the Fed Fund Futures, answer that question for you. Samit Pawar. Did Powell just give in to Trip and possibly lower rate, or did Powell just give in to Trump and possibly lower rates? Yeah, I mean, that's essentially what just happened. If I'm a swing trader, this dovish tone today should guide me to liquidate my position, correct? No. Wouldn't you agree investors would believe now is a great time to continue investing for the next couple months? I mean, it's been a great time to invest for the past couple months already. If you were paying attention to the signal, these past couple days, as everyone was super fearful, those were great buying opportunities. And again, I don't know why people were so bearish heading into this. When you just have the signal, again, the green bookshelf in the background has continued to say, do not short the S&P 500. It's green, which means the S&P is in a bullish trend. If something is in a bullish trend, do not short it. If something is in a bearish trend, don't try and pick bottoms. Wait for it to go back to bullish. All right. So that's pretty much what the reaction was today. I appreciate everyone here for joining. As always, if you guys have any type of questions about our model, if you guys would like more clarity and confidence heading into these events with clear, macro insights, I highly recommend that you guys check out our macro investing community. There's a 7-day free trial if you guys want to try it out. If not, no problem. You can cancel it after the 7 days, but we've had some great success in there, as you guys have seen with just doing these live streams. All right. So that concludes today's live stream. I appreciate everyone joining this special edition. We will still do our Sunday macro wrap up. That's every single Sunday at 8 p.m. Eastern time. If you guys haven't already, subscribed to our YouTube, hit that like, share, all those great things. And have a great rest of your weekend, and we will catch you on Sunday. Bye, everyone.